Hi, everyone. I'm John Zoller, CIO of MAI Capital, here with the latest edition of the MAI Market Update. This month, I'm happy to be joined again by Chris Crisanti, MAI's Chief Equity Strategist, for a conversation around the current market environment. Chris, thanks so much for joining me today.
John, it's good to be with you again.
Well, Chris, a lot's changed for the equity markets over the last 12 months, not least of which is the fact that interest rates are a lot higher, which has changed the calculus on what different investments are worth. So, what do you make of the current backdrop for the market?
Well, John, I get asked a lot by clients about when will things, quote, get back to normal. They're worried the market has fallen, but they're mostly worried that interest rates have just risen too much, that mortgages are now sky high. They're going to kill the housing market. They're worried about their own refinancing. And generally, they're worried about the economy just grinding to a halt with higher interest rates. Here now, I think it's really important to pull the lens back a bit and look at the long term. And by that, I mean events both before and after the great financial crisis of 2008, because that really is the turning point we have to zoom in on. So, as our viewers are certainly aware, in 2008, the financial markets and the entire financial industry imploded. It was a scary time for everyone, especially those of us that were looking at quote screens at the time. The Federal Reserve moved quickly. It lowered rates for the first time ever to zero and embarked on all sorts of programs to stabilize the economy. So, in the wake of that, we began to hear a new phrase. We are entering the quote, the new normal. And that described an era of extremely low interest rates, of low inflation, sluggish employment, and very low GDP growth. Other phrases that became popular at the time were pushing on a string, which described the Federal Reserve's efforts to try to revive the economy. Priming the pump, they're lowering rates and adding stimulus to prime the pump. Ironically, the only thing that finally ended this cycle was the pandemic. So the pandemic scared policymakers so much that talk about pump priming that they threw more than $5 trillion at the economy in 2020 over just a period of 6 to 9 months. And like the image I like is those old pictures of an old automobile with a crank starter where it's hard to start it the first few times, and then if you really catch it, it booms to life, and then it becomes a self-sustaining motion. So that's what happened to the economy really in 2020. And it's no surprise, it's economics 101 that inflation came roaring back, GDP rose quickly, and the economy really got back on its feet. But I like to say, so that the last 15 years weren't normal. We're finally back to the pre 2008. So I like to call the era we're entering now the old normal.
Hmm. Interesting the way to put things. The old normal. Let's stick on that for a minute. Can you give some concrete examples of what the old normal is and how we got there?
Absolutely, John. And I think the best way to look at it, there's lots of ways to look at it, but my favorite in just one picture is the Fed funds rate going back 70 years. So going back to the 1950s. And I think we can put a picture up on the screen. As you can see by this chart, the line is the average level of Fed's funds, or what we think of as interest rates, over the last 70 years. And you can see right at the right hand edge of the chart, we're just getting back to normal now. And if you look at what is quote unquote abnormal, it would be the last 15 years where interest rates were just floating along zero there for so long. So um, it seems like higher interest rates uh, are here to stay, not because there's horrible inflation or things like that, but more because the economy is getting back to normal. And I suspect, and I frankly hope, and this is somewhat controversial, that rates will be here for a while, the higher rates.
That is interesting that you say that that's your hope because when you follow the day-to-day moves in the market, it seems like that's exactly the thing markets are rooting against is higher interest rates. So what's behind that hope that you have?
Well, look, nobody likes to pay more for their mortgage or things like that. But as long as rates don't get too high, what I would say is that higher rates are not a bug, but they're a feature of a stronger economy. one that's not supported by the Federal Reserve, one that can stand on its own 2 feet. Now, I, obviously, again, nobody likes to pay more for their mortgage, but if at the same time you have a job, that job is accompanied by annual pay raises, and you feel like you have a brighter future because the economy is really chugging along, higher rates are an acceptable trade-off. My strong hope, and I think now that it is coming true, is that we finally reach what I would call escape velocity, and the economy won't need to return to the constant support from the Federal Reserve in order to support stock prices or housing or employment. And in the long run, even though it comes with higher rates, that's healthier for investors. But there are some conditions to going back to the old normal, and so not everything is perfect.
There's always a catch, isn't there? So what are those conditions, or what's the bad news that comes along with these rising interest rates?
There are some negatives, but I would posit that they're negatives only in the sense that there's no free lunch is a negative. Yeah, that's a negative, but it's just more normal, and we can adjust for this. So there really are five negatives that happen now that we're in higher rates. All of them are manageable. The first is that for the first time in 15 years, there are alternatives to equities. There was a saying that there is no alternative. We called it TINA, and that supported the equity market. Well, Tina, unfortunately for her, is dead. And bonds are a terrific alternative right now. You can get 5% bonds, which seem awfully attractive at a point where the stock market is going down. So there is an alternative. That's the first negative. The second negative, and this is important, is that balance sheets matter again. Debt is more expensive. Floating rate debt is obviously floating upwards. And companies that have large debt that is maturing and they have to roll it over, they're going to have to roll it over at much higher cost. So balance sheets, which have been ignored really for 15 years, are going to matter. We're going to have to choose higher quality companies, companies that can make it through a softer economy without, frankly, being unable to pay their debt. The third negative, and this is really under the no free lunch category, is that no earnings, no cash flow companies, which came public in scores over the last 3 or 4 years, will face a much harder time now, either coming public or if they're already public, raising additional capital. In the last 6 months, there have been virtually no IPOs, for example. So innovation is going to get a little more difficult to fund. And a fourth negative is that the discount rate for growth is much higher. Now, that sounds very wonky and mathematical, but if you think about it, let's say Tesla is a great example. Let's say they're going to have terrific earnings in 2028 or 2029, so 5 or 6 years from now. Well, investors are going to pay a certain amount for that prospective future growth. But if interest rates in general are high, those numbers 5 years from now get discounted back at much more sharp, higher rate. And that's worth less today. So that's a large reason that so many growth companies have declined over the last 18 months, is simply that their future growth is simply not worth as much in today's dollars. And finally, the final negative in investing in a more normal interest rate environment is that the glass is now half empty. Psychologically, investors start focusing on what could go wrong with an investment, not the unlimited potential of a growth company. And that was kind of the headlines from 2021 is, oh, we love this company. It's got electric cars. It's got cryptocurrency. And all they could see was the upside. Well, now they're starting to focus on the downside. So those are the negatives of a higher interest rate economy.
Well, Chris, after hearing all those negatives, I think I'm ready for the positives.
Well, John, the good news is that there are a bunch of positives, and yes, it's tougher to invest in an economy where money isn't free. In other words, there are real interest rates. But it's not only is it not impossible to do that, but there have been many years where there's been terrific results in economies with what I would call normal interest rates. Um, what's important to remember is that the market has higher rates because the economy is doing better. And that is, at the end of the day, a good thing for corporate earnings, which, again, at the end of the day, is what drives stock prices. My favorite example is the period of 5 years from 1995 through 1999. During those years, the Fed funds rate averaged 5.4%. so about a half a percent higher than it is now. And it got as high as 6%. And mortgage rates were 7, 8% off of that. So, and in those 5 years, the S&P index rose 250%. So that's more than tripling. So I am not at all predicting that that's going to happen simply because rates are higher. My point here is only to say that higher rates don't necessarily mean a bad equity market. Often, as we've discussed, higher rates are the results of a stronger economy, and the stronger economy leads to higher corporate earnings. Again, this is not a prediction for a higher market ahead, but it is a pushback against the argument that, oh my gosh, we have higher rates, the market has to go down. That's simply not historically true.
Well, Chris, I think this has been really helpful just to provide the perspective on historical interest rates and how the economy and markets have in the past withstood those periods of time pretty well. So hopefully, we'll be sitting here in 12 months and saying the same is true for the economy and market today. And to our clients who are listening in, please know these are conversations that we are having internally all the time with the goal of reevaluating how we're positioning your portfolio to meet your long term goals. As always, we greatly value the opportunity to partner with you in your financial life as a trusted advisor and a steady hand to guide you through challenging periods in the markets like we've experienced over the past year. And as always, please reach out to your wealth advisor at any time to discuss your portfolio in more detail. Thanks so much for listening, and we'll see you next time.